Welcome to Financial Insider Weekly. I'm your host, Michael Gray, CPA. My guest today is Scott Hazlett. Scott is a California attorney and certified public accountant who practices in the areas of taxation, real estate planning, financial problem resolution, and 1031 exchanges. He is a certified specialist in taxation law, California State Board of Legal Specialization. He's also a qualified intermediary for tax-deferred exchanges. Scott previously worked with Price Waterhouse and has been a CPA for over 25 years. And how long have you been an attorney now?
About 16 years.
16 years, okay. And Scott graduated from the University of Michigan with a degree from his business school and from Taft University School of Law in 1996 and has his own law firm. He is a past president of the East Bay chapter of the California Society of Certified Public Accountants, and in a past life, he was a sports writer covering Major League Baseball, National Football League, and other sports. Scott, thank you for joining me today.
Well, thanks for having me. I appreciate it.
Okay. Today, Scott and I are going to be talking about what's going on with short sales and foreclosures. I call it the short sale and foreclosure wars. Scott, as I said, has real estate law practice, and he has been helping a lot of people with short sales and foreclosures. Also in my tax practice, I've also been helping quite a few people with these problems. So between the two of us, we've got quite a bit of background in this area. As we get started, I want to say we're talking about some pretty heavy stuff here. And so we want you to see your own tax advisor, your own attorney related to this. This is just the beginning of a conversation that you should be having with them. Also, Scott is a California attorney and CPA. I am a California CPA. The laws vary a little bit from state to state related to this. And so, again, I want to alert you that you need to fine-tune this advice and some of the things that we're talking about. So with that, we'll get started. Okay, Scott, so how did this whole thing develop where suddenly we've been dealing now for a couple of years?
It's been a while. It's been over 5 years, I think, since those first discussions of my house is underwater, that kind of thing. Underwater meaning, of course, the value of the property is less than the balance owing on the mortgage or mortgages in some cases. Mm-hmm. In my practice, I've had the pleasure, privilege, heartache of counseling at least 500 individuals and families about their house. I mean, the phone is ringing, and there's 2 to 3, still to this day, 2 to 3, 4 times a week. People will come in for 1 to 2 hour consultation about, here's my story, what do I do, how much jail time is involved. I mean, all the stories that, and the stories are a common theme, but every one of them is a little bit unique, and everybody's situation is a little bit different. So, and I can't stress enough that what I find is people come in and they say, well, my situation is this and this and this, and my brother-in-law really got a great deal from Bank X, or my sister-in-law got torched by a different place, and I don't want that, and I want the good deal, and how to, and so forth. And what I'm constantly finding is, if you really drill down, the facts of one person's situation vary enough from that other person where it doesn't apply. And so, as you say, state law varies. Anybody watching this on the internet ultimately is going to look at this and say, wow, geez, that's, And in addition to that, I get the questions, particularly in California, because of course that's what we're dealing with mostly. They say, oh, California is a non-recourse state, or California is a recourse state. Well, that's a too broad of a generalization. Mm-hmm. What you need to know is, what are my facts? What are the laws that apply to me? What have I done? What can I do? What if I do something? What if I don't do something? Is there something I can do to improve my situation?
Okay.
And so that's really the overview of what's been happening.
Okay. Now it's September 25th, actually, 2012. Are things starting to slow down a little bit?
No, not really. I mean, people are still calling. I think there's been one thing I can point to is the fact that in certain, what I've discovered, and this is all very anecdotal, but what I've discovered over the years is that traditionally, when a lender is, when a loan is in default, the remedy, in California anyway, the remedy is the lender will pursue a foreclosure, and then ultimately within a number of months, the property will be auctioned off, and the lender will either get the property or get the money. The owner is out, the deal is over, and that kind of a thing, so forth. Now, with so many of these properties, for example, in a particular zip code X has got every house in that zip code is underwater. And so if the banks took that strategy, what would happen is they'd have a bunch of inventory and they'd just be competing with themselves, and they would never get the value out. So the fascinating thing is that there's been a lot of denial at the borrower level. There's frankly denial at the lender level, or a strategic, conscious decision of lenders to say, look, we're not going to go into zip code X. We'd rather let that person sit there, live there for free, because they're going to be our squatter anyway. So as a result, there's people still coming around, okay, I'm doing this, I'm doing that. Or just fatigue. They've tried to keep it going. They've cleaned out their 401k accounts. They've done everything they can to keep the property. And finally they say, enough, I'm out of here.
Yeah, okay. Okay, real estate salespeople often promote short sales as the best alternative when the borrower is underwater. Is that true? Actually, I think that the answer has changed a little bit on this.
It has. It has. In 2011, and in fact in July of 2011, and then again, this is for California, so this won't apply to other states. There was a rule enacted called 580E, as in Edward, and the 580E rule says, it's a code of civil procedure, and it says basically if the lender or lenders consent, so if you got one loan and that lender consents to the short sale, and even though they don't recover all of the balance owing, so let's say they're owed $700,000 and they get $300,000 of the sale, once they consent to that, the deal's off. The other $400 is waived or exonerated, so the borrower really has an incentive to do that. And the same would be true of a second loan. So let's say there's a loan of $500 and then a second loan of $100, property worth $200,000 or $300,000 or something. On the sale, that second lender is maybe going to get $15,000 to $20,000 of the proceeds of the sale. But having done so, they are waiving their balance, and the borrower actually can make that out. Now, before that law happened, it was very tricky, because the second lender would come around typically, and they would say, well, okay, we'll take the $20,000 now, but you still owe us $80,000, and we'll come back and see you later. Well, that's not the truth. That's not how it works anymore.
Right.
So short sales are more attractive by virtue of that.
Yeah. There's another thing too, and that is, as I understand it anyway, and maybe you can confirm this, that like when you're in a foreclosure situation, the protection that was there before was mostly for the person who was living in their home. It was their residence, whereas the person who was, a property that they were renting out, for example, they didn't get the same sort of protection after the foreclosure related to the...
Well, that gets into, in the California rules, that gets into recourse versus non-recourse. Now, lenders do have the right, although they almost never use it, but they do have the right to file a lawsuit to get the whole balance. So if they're owed $700 and the house is worth $300, they can sue the borrower. Unfortunately, the reason why it doesn't work is because usually the borrower doesn't have any money anyway. So the house is really the only remedy. So California allows an alternative, which is the most common thing, which is called the non-judicial foreclosure. Yeah. And the attractiveness for the lender is it's fast, it's cheap. Mm-hmm. You get the deal done. There's no court. There's no bickering, and so it's a really straight line to the finish line. However, upon the completion of the non-judicial foreclosure, that deficiency, that balance owing, is waived, and so it's really a trade-off. But still, most lenders go for that because they know they probably will never get that deficiency anyway. Yeah. Okay.
Okay. Would some homeowners be better off by walking away or going through a foreclosure? So,
well, those are probably one and the same.
Basically, one and the same. Are they better just walking off? So,
Well, I always say there's 5 things to do with a loan. You can either pay it, right?
Okay.
You could try to do a short sale. You could try to modify the loan. In other words, go to the lender and say, I can't afford $3,000 a month, but I can afford $2,000 a month. You could try to say, look, I'll just give you the property in lieu of a foreclosure, or you can put your head in the sand and let the lender take the action, which is the foreclosure. The main advantage, in my view, of a foreclosure in California, again, it varies. Nevada is significantly different, and most other states are. But in California, the lender takes the property and it's over. So it's kind of hassle-free. You don't have to have a real estate agent in there. You don't have to show. And the other interesting thing is that if you make that strategic decision to take the foreclosure, you're going to end up in the house living there for free, perhaps for quite a while, 1 to 2 to 3 years perhaps. Now, by contrast, the other typical option is the short sale. What does a short sale give you? In both cases, you're getting no money, and your occupancy will end at some point. The short sale is a real estate agent that you don't have to pay for, but they're in your face. Okay, so that's a hassle, and you are definitely going to have an end date. You have to leave, and you have to stop living there. The main advantage of a short sale, when you compare it to a foreclosure, is that your credit record is somewhat better. They're both very negative events, but it's somewhat better to do the short sale.
Okay. I've heard that Freddie Mac and Fannie Mae have been threatening a penalty if a homeowner walks away from a mortgage. And have you heard much about that? How would it work?
Yeah, so by and large, the loans in the United States are sold in the secondary market. Fannie Mae and Freddie Mac are quasi-government. They're private companies, but they're backed by the government effectively. And they set the guidelines for who qualifies for loans. And one of the guidelines, one of the questions that they would ask you on your app when you apply for the loan would be, have you ever suffered a foreclosure, or have you ever had a short sale? So you answer truthfully. And they might have a guideline that says, well, geez, you had a foreclosure, and they look into it. So we're not going to give you a Fannie Mae style loan, which is the good rates. That's the 2 and 3% being advertised on the radio. We're not going to give you that loan till 7 years passes. And by contrast, depending on who you talk to, and I think the rules change to some extent, the short sale might be 2-year moratorium, 4 years, something along those lines. And there's exceptions to everything, I recognize. But I think the philosophy is that the whole world wants the borrower, wants the homeowner to try to work with somebody, not just stick their head in the sand on these issues.
Okay. Now, on some of these transactions, what happens is you have a debt cancellation.
Mm-hmm. So now you're talking income taxes.
Right, for income tax. Now we're sort of switching gears a little bit.
Right.
And so they issue this 1099-C form.
Mm-hmm.
Now, is that binding on the lender as far as now they can't take any action because they said that it's canceled on this form?
Yeah, no, the IRS form is just a form. That's a report. That's not legally binding on anybody. And these things do get issued in mistake, either they shouldn't have been issued, number one, or they have incorrect information included on
I've heard
it.
an awful lot of people say that basically an awful lot of them seem to come out wrong.
Yeah, right,
So
correct.
It's a bit of a hassle.
So if you're doing your own taxes, which buckle your safety belts if you're doing your taxes on a foreclosure year, but if you are doing your own taxes, number one, you don't treat it as gospel truth. You really need to drill down. I mean, there's a comment, for example, I think box 5 on that form that says, is the loan recourse or non-recourse, yes or no? And those are often wrong. Mm-hmm. And the tax outcome is significantly different, whether it's recourse or non-recourse, as you know.
Yeah. Okay. So I think we talked a little bit around this, but maybe you can comment just briefly. So now you've got a foreclosure. Does that prevent when the first mortgage lender forecloses, does that prevent the junior mortgage, which is typically going to be an equity line,
right,
from collecting on their loans?
Yeah, so the facts are you got a $400,000 first, you got a $100,000 line of credit, the house is worth $50, right, or something not very much. You put your head in the sand thinking, oh, if I just go into foreclosure, all my troubles will be wiped away. Now, again, we're talking California. We're not talking other states.
Right.
So first proceeds to foreclosure, they grab the house, the owner is ejected, that part of it's over. So first is dead, house is dead, and the borrower's thinking, well, I've done the foreclosure, so the second is dead too. That's not true. The second is said to be the sold out junior. So what happens in that situation is that the second no longer has the collateral, but it's like a big unsecured debt, $100,000 debt. So now they have the right to immediately go after the taxpayer lawsuit or other collection, whatever legal collection means there are. And that comes as a surprise to somebody who's trying to do self-help in this area.
Right.
So it's very, very troubling.
Yeah. How are government programs for loan modifications working?
I think the governments and the government programs and the agencies and the lenders mean well. I think that there's such a crush of situations, applications, files, whatever you want to call them. I think there's so many that the system is still very much overwhelmed. When people ask me about a mod in particular, what we're talking about there is there's a loan. Let's say the loan's $300,000, and let's say the payment's $1,500, and let's say that the taxes and insurance are $500 on top of that, so a $2,000 payment. And let's say that the taxpayer is a two-earner family, and all of a sudden one spouse loses a job. Well, the idea of the mod is that there's been not a complete loss of income for the household, but a significant decrease, and that's kind of the sweet spot. Now, by contrast, there's two other situations where one is the taxpayer makes a ton of money and they really can't afford it, but their house has gone down in value and they feel like, hey, I've paid my bills, these other people are getting a break, I should get a break too. So those people make the application, they say you make too much money. And surprisingly, the other end of the spectrum, I lost my job and I was the only wage earner in the house, so our income right now is zero, I'd like to have a mod. The lender says, well, we'll give you a mod, but we know from experience that in 2 months you'll be right back in foreclosure. So we're not going to give you the mod. So let's go with a short sale or foreclosure. Let's do this. So it's that in-between group that can benefit by those programs.
Okay. So we talked a little bit about non-recourse mortgages and recourse mortgages. Maybe you could explain those. And can you tell just by looking at a mortgage whether it's recourse or non-recourse?
No, it's depending on how you look at it, it's easier than that. Maybe. In California, there's a rule called CCP 580B, and you can look it up on the internet in the California website. And it basically says that certain kinds of loans are non-recourse by the fact pattern. So the main fact pattern is, let's say I buy a house in San Jose, it's a principal residence for myself and my family. I get a loan from Bank X, that's the loan that's said to be a purchase loan, money used to buy the property, and I occupy the property, and the property is 1 unit, or it could be up to 4. I could have renters living in the other units. So that loan is characterized as non-recourse. Now the other type of non-recourse is a loan, let's say I buy that property as a rental property, I want to use it as an investment, and the seller has a bunch of equity. So he says, look, I don't even have to get a loan, I'll just carry the paper. In other words, I'm going to make my payments to that guy. Well, that's also non-recourse because it's sort of a property transaction. And then the third style, most typically, is mostly a commercial loan.
Yeah.
The loan that says this is a non-recourse loan. And so that's where you read it. Now the other two, it will not say that. Mm-hmm. Those are just factual circumstances that you have to go back and consult with the law. Mm-hmm. Now having said that, anything that's not in those 3 categories is recourse for California. Okay. And therefore can lead to bigger troubles.
Okay, so maybe we can talk a little bit, just very briefly, about some of the tax consequences, the difference between a recourse and a non-recourse.
Right. So on a non-recourse loan, if you have a foreclosure or a short sale, the proceed or the balance of the loan is considered proceeds. So let's say I borrowed $500,000 and it was seller financing, so it's non-recourse, and I put $200,000 down, and then the property goes down in value to $300,000, and I sell it. And the guy who had the 500 note, he agrees to take the 300, and it's over. The answer on that is that original 500 that I borrowed is the sales proceeds generally. irrespective of the fact that I got no money, I lost my down payment, all that kind of stuff. So that's not cancellation of debt for taxes, that's proceeds. Now by contrast, let's take a more typical situation. I buy a property, it's my own home, I get a loan from Bank X, a 7% loan, and then Bank Y comes along and said, I'll offer you 3 3/8, so I refi, and I don't take any money, but I just get a loan, I replace my $500,000 loan with a new loan. That loan's recourse, because I didn't use it to buy, it's a replacement, but I didn't use it to buy, so that's a recourse. So property goes down in value to 100, short sale, there's a 400 deficiency, that's ordinary income. Ordinary taxable, there's some exclusions, but that's ordinary income. And so that's the main distinction.
Right. So why don't we talk a little bit around this, because we're having a tax law that we've been relying on that's coming up for expiration this year.
That's correct.
So it seems like our entire tax law is turning into a pumpkin.
Right.
So maybe you can talk a little bit about the Mortgage Forgiveness Debt Relief Act of 2007 and what's supposed to happen at the end of this year.
So one thing is in the course of my practice, now the question lately, of course, as you said, this is September, and we've got about 3 months to go till the year end. A lot of the times I just want to know, does this law expiration affect me? Or I read on the internet, which we all know is 100% true, right? I read on the internet this thing, and then we walk through the facts and we determine they don't really have that kind of debt. But let me give you an example. So you buy a house for $500,000, you get a loan for $400,000, $100,000 down payment. You refi that loan in California. So it's $400,000 still. For tax purposes, that's said to be acquisition debt because you used it to buy the property originally. You got a replacement of it, but the character stays the same. For the California law purposes, however, it's recourse because even though it's the same balance, it's been replaced. So there's a dichotomy. There's a dichotomy there. So then the property goes down in value to $200,000, and I fail to make the payments, and they foreclose on me. So I lose the property. So the difference between the 400 and the 200 is said to be cancellation of debt. Because it was purchase loan of a main home, and it remained my main home, I don't have to pay taxes on that income because of this rule, which will expire at the end of 2012. So the takeaway on that is, and of course this is going to be broadcast way too late, but the takeaway is whatever you can do to sell that property, if you're in those facts, you sell that property by the end of the year, or attend church and pray for the law change. That's the other approach.
Yeah, so hopefully we will see an extension because there are still a lot of people that, like you said, the banks have sort of been dragging their feet on this. They view some of this non-foreclosed property as inventory.
Yeah, well, the one thing I want to comment on, though, is that some people, and I've heard tax advisors say this too, but some people using those facts, let's say I bought a house in 1988 for $50,000 and my loan was $40,000, and then over the years I've refied and taken money out. Now my loan's $600,000. It's still my main home. That is not the kind of loan.
It's not qualified indebtedness.
Yeah, it's not qualified acquisition indebtedness. So you're not going to get that rule, and that's where the confusion comes in oftentimes.
Yeah. So an awful lot of people, frankly, were using their homes as a piggy bank.
Correct.
And so they were refinancing. We were talking about just a moment ago. You were giving the example of the person who's doing a straight refi of his balance. He wasn't taking any additional money out. But a lot of people were taking a lot of money out.
Right. Every time to clean up their act.
And so they're in the situation where that debt for the additional amount that they took out will not qualify, and so now they will have taxable income. Why? Well, they took cash.
Right.
And it's gone now.
Yeah, right. It was tax-free then, now it's taxable today.
Okay. Well, what are some other alternatives for exclusion? Because that's not the only thing that we can rely on.
Correct. The other interesting thing is that person with a piggyback approach, oftentimes they're said to be insolvent. Mm-hmm. And insolvency simply means that on the day of the foreclosure or the short sale, you go through your balance sheet, your assets and your liabilities at their fair value, and you say, am I negative net worth or positive net worth? So let's just say I go through my list. I got cars, dogs, whatever, furniture. I got a pension maybe. I got a 401k. Those count at the full value.
Yeah.
and I have these debts, including the foreclosed debt, interestingly, and including the property that's being foreclosed. I go through a list of that, and I determine that my negative net worth is, say, $50,000. And let's say that I get debt that's relieved, forgiven, never paid off, of $75,000. Using this insolvency rule, of the 75, 50 is not taxable, and the 25 is taxable income, unless you have some other exclusion. So,
Okay.
but
So-
insolvency is a prime escape, if you will, for a taxable income.
Right, and that will remain even
That's
after-
correct. That's going to live beyond the year end.
And then the second one is bankruptcy.
That's correct. If you file bankruptcy and your debts are exonerated in bankruptcy, then those are not considered taxable income for debt relief.
So we'll still have some escape hatches, but they're going to be painful ones.
Correct.
And particularly that, it's really my last question that I've got here, but that you need to really document this stuff. There's an awful lot of people that are very careless about the records that they keep.
Yes, correct, correct.
And so I've asked people, okay, well, we need to document your insolvency and you know, what was your debt? So we've got all the paperwork ready for when you get examined here.
Oh yeah, absolutely. Well, even you know, in this acquisition debt rule, some people have bought houses back in the 80s, and the way the rule works is that there was a cutoff date in 87, a grandfather date, acquisition debt. I mean, and people look at me like I'm from the moon when I start asking these questions. So, but that is, you know, a relevant question.
Yeah. So anyway, but they throw away their credit card bills and all
Yeah,
this
correct.
other stuff.
Right.
I've had this, and so I said, okay, well, you have to go back to the bank and get your credit card, because we have to find out what the balance was at the time that you had this cancellation happen.
Correct, correct.
And in some cases, we have to get some appraisals done, because they may still have some real estate or
Right, correct.
other things, make some valuation work. It's almost like putting together an estate tax return.
Right.
So anyway, so maybe you have a final word of wisdom to offer our viewers related
Well,
to this.
you know, if you're thinking about, if you're in this situation, or if you have a family member, my approach, I kind of fell into this practice only because I've got the interesting intersection of the taxes and the legal at the same time, and so
Yeah.
I find it to be, sometimes it's a tax question, sometimes it's a legal question, sometimes it's a social question. I've had people come in and they say, we want to do this and that and the other thing, and I say, well, tell me about your family. And they say, well, you know, Susie wants to go to Stanford and we're going to get student loans. And I say, well, yeah, but if you do this over here, your credit's going to be wrecked, and Susie goes to, you know, JC or something. So it's always worth, it's not something that a computer program can figure out for you. It's really is a counseling session, and it's been, you know, it's been rewarding helping people, even though the situation is very sad.
Okay.
So,
Thanks a lot for joining me, Scott. Folks, we're all out of time. Be careful out there. Get some tax and legal advice, and we'll see you next time on Financial Insider Weekly.
okay.